Which investment type typically carries the least risk? In the world of investing, there are many different types of investments. Some carry a higher risk than others. In this video, we will explore the types of investments that typically carry the least risk. The types of investments that typically carry the least risk are typically bonds, certificates of deposit, treasury securities, and asset-backed securities such as mortgages. But before we go more in depth into it, which investment type typically carries the least risk? We'll first define. What is investment risk? Investment risk is the likelihood that an investment will lose value. Investing in stocks, bonds, or other types of investments is a risky proposition. But don't worry, it's not all doom and gloom when it comes to investing. There are many ways to invest in the market without risking your hard-earned money. One way to reduce investment risk is by using a mutual fund or exchange-traded fund, ETF. Both of these investment vehicles are easy to understand and have a low cost of entry. Types of investment risk. Investment risk can take many forms. It can be classified into three broad categories. 1. Market risk. Market risk is the risk that an asset will lose value over time. For example, if you invested $10,000 in a stock, it could drop in value. If you then sold that stock for $5,000, you would lose $5,000 in value. 2. Credit risk. Credit risk is the risk that an investment will not be paid back. This is similar to market risk, but is focused on the investor's ability to pay back the investment. For example, if you invested $10,000 in a bond, you could lose the money. But if you are able to sell the bond for more than what you invested, you will receive a return on your investment. 3. Volatility risk. Volatility risk is the risk that an asset will fluctuate in value. The best low-risk investment options. 1. Bank or brokered certificates of deposit. If you're looking to build a substantial amount of wealth, I recommend you start with your bank accounts. A bank account is one of the safest ways to invest your money. Banks are regulated by the government and they have the ability to quickly freeze your account if you're doing anything suspicious. They also have a low interest rate on savings accounts that can be difficult to beat. The only downside to having a bank account is you can't easily move your money into other investments. If you want to diversify your assets, you may have to look elsewhere. 2. Real estate. If you're looking for a way to build wealth that's easy to manage and offers a higher return than a bank account, real estate may be the best choice for you. When you buy a home, you're actually buying an asset that has a built-in cash flow. When you sell a home, you can use the profits to fund your next purchase. Plus, real estate is one of the safest investments you can make because you're not relying on the financial markets to grow your wealth. Real estate is one of the safest ways to invest your money. 3. ETFs and mutual funds. If you're looking for a way to build wealth that's easy to manage and offers a higher return than a bank account, you should consider investing in mutual funds and exchange-traded funds, ETFs. ETFs are similar to mutual funds, but they trade on an exchange like stocks. They're traded throughout the day and provide you with a variety of different investment options. A few things to keep in mind when choosing an ETF. There are many ETFs available, so it's important that you choose one that matches your risk tolerance. You can buy ETFs as a long-term investment or a short-term investment. The choice is yours. It's easy to buy and sell ETFs because they trade on the stock market. ETFs are traded on the New York Stock Exchange, so you can buy them online at any time. That's all on the investment types that have lower risks than others. Of course, there are many more options you can choose from. Plus, if you can afford a higher risk, you can invest on stocks, foreign exchange or forex trading, or cryptocurrency. And the most important thing is not figuring out your risk aversion, or having the will to invest, but to actually start. So go ahead and take that first step, and grow your money.